Hello, and welcome to the California Public Utilities Commission's Broadband Casework Training video series. This particular video is one of a series of short videos designed to introduce critical concepts related to broadband deployment and infrastructure. This video will discuss the concept of network take rates. A network take rate is the percentage of the potential market that actually subscribes to or takes services, hence the term take rate. Briefly, there are two ways that take rates are incredibly important measures of the success of a broadband enterprise. First, take rate is a key element in understanding the financial well-being of that enterprise because it's an element of revenue. What it tells us is if there's a particular revenue number coming from individual subscribers, an average revenue per subscriber or per user, known as ARPU, that ARPU, average revenue per user, multiplied by the take rate, tells us the total revenue of the company. So take rate is obviously a critical way of understanding the number of users and the potential, the existing revenue and market for the enterprise. Secondly, take rate is a quantitative measure of the policy success of the enterprise. When we think about broadband that is being developed by communities, public-private partnerships, local government, tribal government, those broadband networks are motivated by public policy goals, as opposed to the commercial goals that motivate investments in broadband by for-profit entities. So the policy goals of a broadband network are the true goals of why communities get involved in broadband. Take rate, while it has to do with dollars and cents and revenues, is a way, though, of understanding from a quantitative standpoint whether there has been measurable success with regard to the policies. In that, take rate tells us if the community is choosing to subscribe to services over that broadband enterprise, and if those services are aligning with things that members of the community are willing to pay for and subscribe to in terms of the services that they are using with regard to broadband and connectivity. And it tells us further the degree to which the network is filling that market gap, that market gap that is the private sector shortfall in addressing the needs of the community. That gap existed, and that's what motivated the community to deploy a network. Well, the take rate tells us that from a quantitative standpoint, this is the degree to which that market gap has been filled now by this community-focused network. What are the things that will determine take rate? There are a wide range of different considerations, but very briefly, it's important to know that there is frequent alignment with regard to take rate across demographic factors. So, for example, we know that take rates are higher generally for younger generations than much older generations. That has to do with internet use generally being less common among older Americans who are not digital natives and didn't grow up with it. And we know that take rates are higher as household income and household education levels are higher, presumably because of the availability of disposable income to pay for services, but other factors as well. There are also some key elements that determine take rate that have to do with the brand and other local factors of the network owner. So, for example, a network that has a local brand and local identity built into who it is, for example, a community-owned network or a public-private partnership where the operator might be private but has a close connection to the local community, those networks will frequently see higher take rates because of localism. And frankly, what we see in addition is that when it comes to customer service and the consumer experience, local ownership, local management, and local involvement can have enormous differences in increasing that customer service experience, improving the customer service experience, and driving take rate higher. Indeed, most of the small networks that we have observed over the past 20 years that are locally owned, that are able to compete with very large, much better resource networks, are doing so through local customer service by improving the consumer experience through local staffing and a high level of quality around customer service. Finally, though, small local community-owned networks are frequently not going to have the advantage with regard to take rate of bundling. That is, the large-scale incumbents that are able to offer internet plus phone, and very importantly, plus video, and sometimes even mobile, have this advantage when it comes to bundling all those services together that helps them to compete and drive up take rate. And small community-owned or local networks that are offering only internet or maybe internet and phone don't have that bundling benefit. Bundling, though, is something that is generally much more common among older consumers than younger consumers. So the benefit of bundling to take rate may diminish over time. A couple of final thoughts on how to understand take rate is that much of take rate is determined not only by how the enterprise itself is able to operate, offer services, offer customer service, what its pricing is, and so on, but also what kind of competition it faces. And what we see is that for a network where there is no competition at all, or no broadband competition, that is to say just weak DSL at a lower than broadband speed, take rates for a new enterprise after approximately 5 years of operations can be at 45% or above. Some networks approaching 65 or 70% or even higher take rates where they effectively do not face competition at all. In markets, however, where they might be facing DSL and a robust cable broadband competitor, then 35 to 40% take rate for a very well-run, well-managed new broadband enterprise is not uncommon. But the more robust the competition gets, the lower the take rates are. So in an environment with partial fiber to the premises, so some neighborhoods might have fiber to the premises and others cable broadband, and cable tends to be throughout a community in the residential market because of the legacy of the universal service requirements of cable franchising. In a market like that, with cable broadband everywhere and partial fiber to the premises, we see take rates that are in the 30 to 40% range for a well-managed, well-run network. But when we get to an environment where there are two ubiquitous, very robust competitors, so perhaps fiber to the premises throughout a community and cable broadband throughout a community, most new entrants will struggle to achieve higher take rates than 30%, and those take rates will frequently be even lower, not because of a failure of execution or management necessarily, but simply because of the realities of a competitive market. That is the end of this video, and we'll look forward to seeing you on the others. Thank you.